Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Highwoods Properties Inc. Annual Report. Highwoods Properties Inc. offers a range of businesses and services related to office real estate investment trust. The company's primary focus is on owning, developing, acquiring, leasing, and managing properties in the best business districts, BBDs, of 8 major cities across the United States. The company provides various services including property ownership, development, acquisition, leasing, and management. Highwoods Properties, Inc. aims to create exceptional environments and experiences that inspire its customers and teammates to achieve more together. By delivering greater value to its customers, their teammates, and shareholders, the company is in the workplace-making business. The services offered by Highwoods Properties, Inc. can be summarized into several key areas: property ownership, development, acquisition, leasing, management, and workplace-making. These services are designed to create environments and experiences that inspire growth and productivity for businesses and their employees. The Highwoods Properties, Inc. HIW stock price has shown minimal change over the past year, with a 52-week range of $24.18 to $32.76. While this may suggest stability, it is essential to consider the underlying factors that have contributed to this relative calm. One key factor is the company's earnings performance and outlook. Highwoods reported meeting analysts' consensus estimates in Q3 2025, with a return to profitability in Q4 2025 due to gains from property dispositions. The company also provided strong FY 2026 EPS guidance, which likely offered investor confidence and supported the stock price. Strategic investment and portfolio management have also played a crucial role. Highwoods has continued to acquire high-occupancy properties, such as 600 at Legacy Union in CBD Charlotte, and has emphasized owning, developing, acquiring, leasing, and managing properties primarily in best business districts, BBDs, across major southern U.S. cities. Shareholder returns and analyst sentiment have also been supportive. Highwoods declared consistent dividends, which can attract and retain income-focused investors, providing a baseline of demand for the stock. While Wall Street analysts had varied opinions, many firms issued price targets that implied potential upside from the stock's current levels. The broader commercial real estate market context has also contributed to Highwoods' stability. The overall REIT market demonstrated resilient operating performance and maintained reliable access to capital markets throughout 2025. This sector-wide stability provided a supportive backdrop for individual REITs like Highwoods. In conclusion, while the Highwoods Properties, Inc. HIW stock price has shown minimal change over the past year, it is clear that several positive developments and strategic positioning have contributed to this relative calm. The company's earnings performance, strategic investment, shareholder returns, and analyst sentiment, as well as the broader commercial real estate market context, have all played a crucial role in supporting the stock price. Highwoods Properties, Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Highwoods Properties, Inc. trades at a higher price-to-earnings ratio of 23 times and a higher price-to-book ratio of 1.21 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 60% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 7.7%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company are multifaceted and can be attributed to various factors. Owning and operating high-quality workplaces in prime business districts within their footprint is a significant contributor to revenue growth. Additionally, the Development Cash Incentive Plan, leasing commissions paid to in-house professionals, increase in rental rates, higher cost recovery income, impact of newly acquired or developed properties, lower general and administrative expenses, lower interest expense, increased demand for office space, ability to recover increased operating costs through higher rental revenues, higher average occupancy, and higher GAAP rents per rentable square foot are all key drivers. On the other hand, revenue decline can be attributed to factors such as loss of major customers due to bankruptcy or financial difficulties, oversupply of space in markets leading to lower occupancy and rental rates, failure to maintain and improve properties, compliance costs with governmental laws and regulations, discovery of environmentally hazardous conditions on properties, lower than anticipated occupancy rates and rents, construction and lease-up delays resulting in increased debt service expense and construction costs, revenue decline from property dispositions, lower consolidated same-property revenues due to decreased average occupancy and lower cost recoveries, and decline in revenue from specific segments. It is also worth noting that some segments have consistently shown revenue growth, such as the Nashville and Raleigh segments. Furthermore, common stock issuances can provide a boost to revenue growth, but preferred stock does not directly impact revenue. Overall, understanding these drivers of revenue growth and decline is crucial for making informed business decisions and predicting future performance. The company's financial performance is a testament to its ability to generate significant operating cash flow. As evident from the data provided on page 33 and page 66, the net cash provided by operating activities has consistently been in the positive range, with a notable figure of $359,207 recorded for the year 2025. This trend of positive operating cash flow is a clear indication that the company's operations are generating sufficient funds to cover its expenses and investments. The consistency of this trend across multiple years further reinforces the notion that the company has established a stable financial foundation. The company's debt level has experienced significant fluctuations between 2024 and 2025. While some pages indicate no significant change, others show a notable increase in debt levels. Specifically, fixed-rate debt increased by $341.2 million, while variable-rate debt decreased by $79 million during this period. The overall debt level rose from $3,293,559 to $3,554,178. In contrast, the company's interest expenses have shown mixed results. Some pages indicate a decrease in interest expenses, such as a $5,235 reduction on page 42, and a slight decrease over 2 years on pages 58 and 72. However, other pages show an increase in interest expenses, including a rise from $133,584 to $144,603 on page 67. The use of variable rates on borrowings under revolving credit facilities and bank term loans has significantly impacted interest expenses, as noted on page 81. Management is optimistic about the company's outlook and strategy. The company's vision is to be a leader in commercial real estate, generating attractive returns over the long term by developing, acquiring, and owning high-quality office buildings in core markets. In terms of growth and development, management expects significant revenue increases due to new property acquisitions and development projects. A substantial development pipeline, with approximately 4.2 million rentable square feet of office space, is expected to drive growth. Financially, the company anticipates higher net operating income, NOI, in 2026 compared to 2025, indicating improved financial performance. Additionally, management expects available cash and cash equivalents to be sufficient to meet short-term liquidity requirements. However, management also acknowledges potential risks, including deterioration in customers' financial condition, counterparty risk under debt instruments, and difficulty leasing or releasing space on favorable terms. To mitigate these risks, the company aims to limit the impact of interest rate changes by entering into interest rate hedge contracts. Overall, management's outlook is positive, with a focus on growth, development, and financial improvement. While acknowledging potential risks, the company appears well-positioned for long-term success. The company has made several significant acquisitions and divestitures over the past period. In terms of acquisitions, the company has purchased various office buildings and parking garages across different locations, including Charlotte, Raleigh, Dallas, Tampa, and Atlanta. These purchases include a 411,000 square foot office building in Uptown Charlotte for $193.4 million, an Advance Auto Parts tower in Raleigh for $137.9 million, and a 50% interest in the McKinney and Olive building in Dallas. The company has also acquired real estate assets accounted for as asset acquisitions, which is a significant investment strategy. Furthermore, it has purchased 50% interests in several buildings, including the Midtown East building in Tampa and the 2827 Peachtree building in Atlanta. On the other hand, the company has made several divestitures, resulting in significant losses. It sold 3 buildings in Richmond for $42.3 million, as well as several other properties across different locations, including Atlanta, Tampa, Raleigh, Orlando, and Pittsburgh. The company also redeemed a short-term preferred equity investment in the McKinney and Olive joint venture for $80 million. In addition to these transactions, the company sold 50% of its interest in the Markle joint venture to Markle for a loss of $4.7 million. These divestitures demonstrate the company's efforts to restructure and optimize its portfolio, but also highlight the potential risks associated with such transactions. The company has a history of paying dividends to its shareholders. This is evident from various sections in the report, including pages 16, 25, 38, and 98, which confirm that the company has paid dividends in the past. In fact, the company declared a cash dividend of $0.50 per share in each quarter of 2025, and another one on January 29, 2026, page 38. The amount of dividends paid is also mentioned, with $216,728 being paid out in 2025, page 67. On the other hand, there is no evidence to suggest that the company has bought back shares. Pages 15, 25, 26, 30, 38, 41, 58, 81, 98, 104, and 105 all confirm that share buybacks are not mentioned in the report. The only mention of a related transaction is on page 67, where it is stated that $2,130 was spent on share repurchases in 2025, but this amount is small and not directly related to buying back shares. That concludes the financial summary for Highwoods Properties Inc. Feel free to comment below, and I will be happy to answer them when possible.